I usually do control my costs and I also keep track of my revenue. But still, I am not sure of my efficiency. Well, you are not alone. I often hear business owners say, my CFO regularly makes financial reports, but I don't feel I have a good grip on my profitability. मैं क्या करूं? Hi business owners, this is your business coach Nalin Mehta. Welcome to my talk series Kya Karun, specially recorded for you. First, I'm glad you understand the importance of tracking your financials. Sound financial management is the key to success in business. Two simple financial reports, namely profit and loss statement and second balance sheet, can give you a very good grip on the financial health of your business. I often hear business owners use these two terms either interchangeably or loosely together. I have therefore made 3 short videos on this subject. One explaining profit and loss statement, which is P&L, second explaining the balance sheet, and third highlighting where to use which one and how to use them together. In this video, I am talking about the profit and loss statement, which outlines company's revenue, cost and expenses over a specified period of time. Here are the important line items. Net income. Well, net income is the bottom line on a profit and loss statement and most important. Revenue. Your revenue includes the money earned by making sales. And give a separate line item for rare occurrences like revenue from selling assets, receiving tax refunds, etc. Cost of goods sold. This is the cost of producing and selling a product or providing a service. It includes material, labor cost, consumables. These are mostly variable expenses and you should really give a separate line item for each of these type of expenses. Next, gross profit. Gross profit is the result of your revenue minus the cost of goods sold. Next is operating expenses. Operating expenses are the costs associated with running your business. For example, this includes advertising, utilities, rent, vehicle expenses, office supplies, hardware, software, travel, meals, entertainment, training, building leases, equipment purchases, rentals, bank charges, licenses, permits, cell phones, internet services, etc. These expenses depend on the size and type of the business you run and are mostly fixed. Next is depreciation. Depreciation basically shows the value lost that the goods utilized in the business like equipment, cars and machinery incur over a period of time. A new equipment after 1 year would actually depreciate and sell for a lesser value. So that's depreciation. The next is what we call as EBIT, also called operating profit. EBIT stands for earning before interest and tax. Now you can obtain this number by deducting operating expenses from gross profit. Next is earning before tax, EBT. This refers to total revenue minus operating cost, minus goods of cost sold, interest, depreciation, amortization from your total income. EBIT is an indicator of business performance and you can use it to compare your business to other businesses. The last item is owner's draw. This is the business owner's salary or income coming out of the company revenues. Now I often see business owners get the P&L made once a year by their CFO or CA for basically tax purposes or banking purposes. But P&L records display your business ability to generate profit and they need serious attention from you. To get a grip on operations, make your P&L every month, every quarter, convert each line item into percentage of revenue, use the month-on-month percentages to see the trends. Think which discretionary costs you can reduce. If your business has too much fluctuation in revenue, you may convert some of your fixed expenses into variable expenses. Example, you may outsource your payroll, you may outsource your regulatory compliances, and they will be outsourced on a per employee basis. Apart from operations, you can use P&L for many strategic calls. 1. Compare your P&L line item percentage with competitors. Now, some of the competitors do have to publish their P&L, so you can get the data. Benchmark yourself. Get insights into what you are good at and what you need to improve. 2. Do year-on-year comparisons to see long-term trends. Which areas are improving or which areas are worsening? Take appropriate actions. 3. Use P&L to take investment decisions. If you add equipment or you automate an operation, what does it do to your net income? You can calculate your break-even points in different scenarios. To summarize, do understand the importance of different line items in the P&L. Get it made monthly, quarterly, to get insights into your operational efficiencies. You will get many ideas to improve your profitability. Do year-on-year comparisons, benchmarking with competition, and also build P&L scenarios to take prudent, informed investment decisions. Hope this Kya Karu video will help you understand your P&L and make your business more profitable. Thank you very much.